Hello, everyone. Let's spend a few minutes going over what we think, what the important pieces of the statement of changes in stockholders' equity and a balance sheet. They're kind of related directly with each other. Remember, in the order of preparing our financial statements, we'll do the income statement first, then statement of comprehensive income, then a statement of changes in stockholders' equity, and then the balance sheet. Okay. That's the order we do, and then we do the cash flow when we get to that. So that's kind of the order we're actually learning about them as well. So as we look at the statement of equity, when we learned about it way back in earlier accounting classes, we really were just focused on changes in stock in retained earnings. But there are more changes to stockholders' equity than just net income and dividends, which were the changes we learned about in retained earnings in earlier accounting classes. So if we look at that, what happens is really the balance sheet, each item or amount on the balance sheet, we use the statement of retained earning or statement of changes in stockholders' equity to show the changes in those items on the balance sheet. They can become columns, or as we'll look at in a minute, an example, they stay as rows. But the main thing is that each item in the stockholders' equity section of the balance sheet, we're going to be explaining the changes for. And we start with last year's balance sheet, and we end with the balances that go on this year's balance sheet, which allows us to go forward and complete our balance sheet. The ones that we're most interested in, typically we're going to find, and there's a few others that will crop up, but they're much more rare. The ones that we want to make sure we understand: common stock, paid-in capital, retained earnings. We know what that is. We've worked with that before. AOCI, that's accumulated other comprehensive income. We now know what other comprehensive income. This is the accumulated. So now we have two pieces: retained earnings, which is where net income goes, and accumulated other comprehensive income, which is where other comprehensive income goes. And then we have treasury stock as well, which is always a contra account. It's always a negative. It's always going to reduce our stockholders' equity. All right. So that's the pieces. Some of the things that change. All right. We're going to change this is the dividends, of course. We've already looked at that. Sale of new stock. Okay. Sale of new stock, issue that. And we also want to remember that we have a statement of comprehensive income now, and the other comprehensive income part of that. So there's two pieces to statement of comprehensive income. There's the net income, and there's the other comprehensive income. The other comprehensive income goes to the AOCI part of our statement of changes in stockholders' equity, while the net income goes to retained earnings. All right, so that's the thing it splits those two out, and that we've never done before in earlier classes, but now we know about the other comprehensive income. We must have a place for it, or our balance sheet will not balance. So what changes to stockholders' equity we want to make sure we introduce here? We've sort of talked about these in the past, but in earlier classes, but we want to make sure we've got this down pat. Treasury stock is the pre-purchase of our own stock. We're going to record it at cost. It's going to be a debit to treasury stock, a contra equity account, credit to cash when we buy it. When we sell it, treasury stock, we're going to debit cash. We're going to credit treasury stock for the cost of those shares we're selling. And the difference between what we bought and sold the shares for is going to be additional paid-in capital. All right. Stock splits do not actually have a journal entry or impact on our stockholders' equity other than the number of shares, which are also listed when we on the balance sheet part of our stockholders' equity balance sheet part. Okay. Stock dividends, however, are they do have a journal entry, and it'll always involve a debit to retained earnings, just like regular dividends. But instead of crediting cash, because that's not what's happening, we're issuing new stock. And so we're going to credit common stock for the par value and credit additional paid-in capital, which is exactly how we issue new stock, as we credit the par value to common stock and we credit additional paid-in capital for the difference between what we sell it for to the investors and its par value. Remember, par value is a imaginary minimum value that we have to sell it for. The thing to remember with stock dividends is if they are a large stock dividend, and there's always been some controversy about what constitutes a large stock dividend, but certainly over 25% stock dividend is considered large. It is recorded at its par value. So it is debit retained earnings for par value for the number of shares, credit, all right, the common stock for par value. And there's no additional paid-in capital involved. If it's a small stock dividend, then it is done at market value. And small stock dividends have become almost obsolete in today's world. But if that happens, you are going to debit retained earnings for the number of shares times its market value, with a credit going to common stock and a credit to additional paid-in capital to make it balance. You will also see share-based compensation, that meaning when a company gives its employees stock options, restricted stock units, other forms of stock-based compensation, because they're giving stock as compensation. Roughly what happens is there is a debit to an expense and a credit to stockholders' equity. And how that works out exactly, and the amounts and everything depends on the type of share-based compensation. There's a lot of rules and over what time period they earn it and all that good stuff. And those are the things that we're not going to spend time on, but you should know that when you're looking at a statement of stockholders, change in stockholders' equity, you're going to see in a typical corporation some reference to share-based compensation. And then once in a while, you'll see a conversion of bonds, meaning bonds are converted into stock. So you're going to debit the bonds payable and credit stock. And it's going to affect stockholders' equity, just like the sale of new stock. All right. So let's look at a actual statement here. We're going to use Verizon, for example, here. Here is the balance sheet, 2 years. The stockholders' equity section is circled here. This is last year, and this is the most recent year, bolded. So this is going to be the beginning point for each of the changes in stockholders' equity. And this is going to be the ending point. All right. Which in theory, if we were doing this in order, we won't know yet. In fact, we would know what those ending balances are because we do the statement of stockholders' equity. So we're going to expect to see common stock, additional paid-in capital, retained earnings, accumulated other comprehensive loss. It's not AOCI, it's AOCL, because they have lost money in the past on that, okay, rather than gains. Treasury stock, which they refer to as common stock in treasury, deferred compensation. We talked about employee compensation and non-controlling interest, which we'll talk a little bit about when we get to the balance sheet. Okay, just the same as we did with our income statement. So we go down to the statement of stockholders' equity or changes in equity. There was no change in the common stock, as you see. 2024, the amount's 429. 2023 was 429. Okay. For additional paid-in capital, there was a beginning, and then there was other, and we could look up the note. Okay. The point being the things that we're looking for, that went down, and the balance was 466 at the end of the year. So those two numbers, if we went back to our statement, there's the beginning, there's our ending. Matches up exactly the numbers there. Retained earnings, net income, added as we know, dividends paid out, and then there's probably some other, it's not enough to worry about. Okay, and that's our balance at the end, which goes on the balance sheet. AOCI, okay, balanced. Here's our other comprehensive income items, other loss, and then our balance at the end. Treasury stock. And we try to do two things. They try to give us two pieces of information. The shares that are happening and the amount. So only the amounts would be journal entries. Okay, but they started with 3, and all the amounts are in millions. The shares are in thousands. So this is 3.8 billion. Okay. Employee plans, which is often a way that they issue treasury stock. It means that they're selling more treasury stock. So it's not going, those shares are no longer in the treasury. That's why it's less negative or positive. That would be a credit to treasury stock. All right. And the fact that there is you can see this, it goes to the same note. This additional paid-in capital went down. Okay, that means there was a debit. That means that they sold that treasury stock for less than they paid for it when they bought that treasury stock. So when they sold it to their employees, they sold it to those employees for less, okay, than they paid for it. So they're going to reduce treasury stock by the amount they originally paid for that treasury stock. The amount of cash they get from the shareholders or from the employees, obviously, is the debit to cash, and then the difference is a debit to additional paid-in capital, as we mentioned earlier. And then changes in deferred compensation and non-controlling interests. All right, so that gives you the idea of what changes and how it's reported. Okay, we're going to have some other examples. They're going to have each one of these as a column heading. Instead of going left to right, they're going to go across. They're going to go up and down, but that won't give us too much trouble. All right, so that's Verizon. Go back to our slides. We see the points on our balance sheet. So we make a big deal about segregating current assets and long-term assets. We talked about investments earlier when we were talking about unrealized gains and losses. We were talking about the classification of securities, various investments that would be assets. If they are trading, they are current. If they are held for sale, they are long-term. Okay, so that is one of the things that went, and that helps us in our definition of how we handle gains and losses. Okay, when we discussed discontinued operations in our discussion of the income statement and how we separate that at the bottom of our income statement. Same thing happens on the balance sheet. If you have announced that you're selling your business or a part of your business by the end of the year when you do your balance sheet, but you haven't actually transferred the assets, right? Because these things take multiple months to work out. But if you made the announcement, then you move all your assets from that part that you're selling to a current asset and call it assets from discontinued operations, because the future benefit is only going to be in a short period of time because you're going to get rid of it. So that's the required disclosure. And the other thing that affects our balance sheet is what we call subsequent events. Things happen after the balance sheet date. Typically between the time that the balance sheet ends, let's say it's an annual balance sheet on December 31st, between December 31st and when the auditors finish their audit sometime, say March. Some things could happen then that could impact the balance, the amounts on the balance sheet. For instance, let's say a major customer goes bankrupt and announces that, say, early February. That would call into question some of the receivables that we are expecting to collect from them. If that is the case, that subsequent event would actually change the amount we should have as uncollectible accounts on our balance sheet, our allowance. So we may need to go back to December 31st balance sheet and say, yeah, when, you know how we were estimating how much we were going to not collect? That amount is higher because of a subsequent event. So that's a subsequent event that has impact on our balance sheet. Other subsequent events do not, because they wouldn't necessarily change a balance. For instance, let's say that we announce a change in strategy or an acquisition of a new business. As of 12/31, we are still correct. We don't have any new information for what the numbers that are on the balance sheet. A subsequent event might be in our footnotes and might be important information, but it does not require us to change an amount on the balance sheet. So two types of subsequent events. Some are going to help make us go back and restate our balance sheet. Others are not. Okay. So on the liability side, we also want to separate current liabilities from long-term liabilities based on when they are due. Those that have payments over time are going to be partially current, partial long-term. We really want to get these current assets, current liabilities correct, because the current ratio is a very important ratio for bankers and for investors. They like to see that, okay? Current ratio, and be able to calculate that and have confidence that it is a number that they can believe in, that there's not something in the wrong place in terms of current versus long term. And one of the situations that's a little bit controversial is where there is a refinance. Let's say you have a loan that is due next year. So you're at December 31st, 2025, and you have a loan due middle of 2026. That would be a current liability as of this December 31st, right? But what if you were able to have a refinancing plan in place such that you were going to roll that 1 year, that current loan, that loan is due very quickly, into a long-term liability for another 10 years? Well, that's a very common thing. Companies refinance all the time. So what should that be? A current liability, because it's due in a year, less than a year, or a long-term because ultimately it's not going to be due for 10. Well, it depends. What we're going to say is, yes, you can reclassify it as a long-term liability, but only if you have a real assurance. You have an agreement in place, not that you're just kind of thinking about it, but you have an agreement in place. The bank has agreed to it, and it's just a matter of actually executing it. And even if you have that agreement in place, just right at the end of the year, and didn't have time to actually execute it, that would be okay. Assuming that you are in compliance with all the requirements for it with the bank. So the bank says you got to have this, this, and this taken care of before we'll do the refinancing. And if you don't have those, then you can't make it a long-term liability. But if you do have all those and the bank has a signed agreement, then you can actually take something that is due in a year, less than a year, and put it under long-term because or have very good evidence that it can be refinanced and it will not be due for 10 years. Okay. And of course, we have our long-term assets, long-term liabilities like long-term debt, long-term assets are buildings and land and a lot of intangible assets these days that get amortized. Long-term assets get depreciated other than land. Okay, and then under equity, we have the accumulated other comprehensive income as an item that hasn't been there before. And non-controlling interest. We had that on the income statement. That's the part. So when we own 80% of a company, okay, we put 100% of the revenue, 100% of the expenses, okay, on the income statement, and then we just take out the 20% that belongs to somebody else as non-controlling interest at the bottom. Same thing on the balance sheet. We add in all the assets and liabilities from that company because we control them. We control all those assets, but in liquidation, we're not entitled to them. We have to actually give them to the shareholders. If we have sold all the assets, paid off all the liabilities, and left the rest, okay, that part that would go to the other 20% that we don't control is considered non-controlling interest. It's subtracted out at the bottom. So you can see all the assets, but then at the bottom under equity, we realize that we don't really entitled to all of the benefit from those assets going forward. That some percentage of them belongs to some other company. It's usually not a big amount because when we buy a company, we buy most of it, and it's usually small and compared to the whole company as a whole. Okay, so that's the balance sheet issues that come up here, and we've kind of looked at the balance sheet as well for Verizon, at least the stockholders' equity part. But you'll find that these are very consistent across most balance sheets you'll see.